SCHD and VYM might be two of the most popular dividend ETFs in the country, and for good reason. Most people treat them like the same fund, but they are not. And one of them is quietly taking on a risk that has almost nothing to do with dividends, and most people never even notice. I dug into how both funds are actually built, and they're far more different than they look. By the end of this video, you'll know which one I would buy and why this isn't a close decision for me at all. But before we get there, here's the actual question that matters. When you buy a dividend fund, what do you expect it to do for you? Now, it comes down to two things. It should pay a steady, reliable income, and it should get you that income without taking on a bunch of risk that has nothing to do with dividends. So the real test isn't the yield you see on the screen, it's what the fund is actually holding to get you there. And that's where one of these two ETFs run into a real problem. So let's first take a look at both of them. Now, on paper and by name, they're almost identical. SCHD is the Schwab US Dividend Equity ETF. Now, launched in 2011, this ETF has 6 basis points in fees, it holds around $105 billion in AUM, and it has over 100 stocks. The dividend yield sits at around 3.2% and it tracks the Dow Jones US Dividend 100 Index. Now, VYM, on the other hand, is the Vanguard High Dividend Yield ETF. And this is an older ETF launched back in 2006 and is a touch cheaper at only 4 basis points. It tracks the FTSE High Dividend Yield Index. It has about $81 billion in AUM and holds around 600 stocks, and then also has a lower yield of around 2.3%. So on this quick analysis, SCHD runs a much tighter portfolio and then also gives you a higher yield. VYM is far broader and provides you a lower yield, and while you save 2 basis points on fees, you're giving up almost a full percentage point on income. But none of those numbers tell you why they're so different. For that, you have to check the one thing that almost nobody looks at. And this is the rule book each fund is forced to follow, and it's called the index methodology. Now, what the fund holds and how it performs all comes back to this specific methodology. So to start off with SCHD, it begins with a quality filter. A company has to have paid a dividend for over 10 years straight just to qualify. Then it ranks on what's left in financial strength, things like cash flow to debt, return on equity, and dividend growth. Only the strongest 100 or so get in, and no single stock can weigh more than 4% at each rebalance. That's why SCHD is tight and evenly weighted list. It's quality first and then yield is second. Now let's look at VYM. It takes every single US stock, it ranks them by expected dividend yield, and then selects the ones that pay an above average dividend. Then it weighs whatever's left by market cap. So in contrast to SCHD, there's no quality test and no cap on any single name. So when a large company happens to pay a dividend, it lands right on the top just by sheer size, whether it belongs in the income fund or not. And that is the entire reason why Broadcom sits on top of VYM at 7.3%. So once you actually crack open these funds, you can see how the fund methodology plays out in the top holdings. So let's start off with SCHD. We have Abbott, we have Amgen, Merck, Coca-Cola, United Health, Home Depot, Procter & Gamble, and Pepsi, all sitting right around 4%. Now look what these companies have in common. Everything here is pretty defensive. This is the stuff that people keep buying or doing no matter what the economy does, which makes SCHD a bit more stable in practice. Now, the top 10 holdings add up to around 42%. So the takeaway on SCHD is simple. No single company can really hurt this fund on its own, so there's no real single stock risk here. On the other hand, VYM looks a little bit different. So Broadcom, a semiconductor company that has risen substantially on this AI wave, sits alone at the top at about 7.25%. And from there, the holdings change drastically. You've got classic JP Morgan at around 3.4%. Then we got Johnson & Johnson, Exxon, Caterpillar, and Cisco all sitting at around 2%, followed by a huge list of 600 other names with even smaller exposure. The top 10 is only about 26%, with Broadcom making up more than a quarter of that. Here's something worth pointing out. Across both top 10 lists, only 2 stocks actually overlap. And this is United Health and Home Depot. But look at the weights here. SCHD holds at around 4% of them each, while VYM holds them at around 1.5%. So these are the same companies and about 3 times the size position. And if we look at the sector breakdown, it tells the same story as the top 10. SCHD leans into healthcare at around 21% of the portfolio, consumer staples at around 20%, while energy sits at around 15%, and then tech is a bit lower at 13%. VYM, on the other hand, tilts heavily towards financials at around 21%, technology at 18%, and healthcare down at just 13%. So based on that, SCHD is built more like a value play ETF, while VYM looks a lot more like the S&P 500. Now real quick, if you're finding this useful, please hit that subscribe button. This channel is very young and we're about to hit 1,000 subscribers, so I truly appreciate any support I can get. You can also follow me on all my social platforms too. Everything's linked in the description. Okay, now let's get into the performance of these ETFs. So these ETFs are built differently, they have different holdings, and they also move differently, which leaves the one question that everyone truly cares about, which is the performance of these funds. So which one has actually made more money? And the answer isn't the one most people expect. Let's just start recently. So over the past 5 years, VYM has actually won. Its heavier tech weight caught the AI run, and Broadcom drove a lot of that performance. Over that stretch, the more concentrated fund performed better, and that's the best argument anyone can make for VYM. But let's see what happens when you widen the lens. So over the past 10 years, SCHD pulls ahead. Now, if you invested $10,000 in SCHD with dividends reinvested, this would have grown to about $32,700, while that same money in VYM would have grown to about $30,200. That's an annualized return at about 12.6% for SCHD against 11.7% for VYM. And if we go all the way back to SCHD's launch in late 2011, roughly 15 years ago, the gap only gets clearer. So SCHD compounds at around 13% a year, meanwhile VYM is around 12.6%. So if we invested $10,000 in the start of this period, we would have turned that 10 grand into roughly $60,200 in SCHD versus $57,100 in VYM. So over a full cycle of returns, the SCHD ETF won. So here's the pattern. The only window where VYM comes out ahead is that recent 5-year tech run. The longer you actually hold, the more SCHD's steadier approach wins. So after all that, here's where I actually land. I'll give you 2 reasons why SCHD is the stronger dividend fund and 1 real reason why you still might go with VYM. First, SCHD pays you more. Just a reminder, SCHD has a yield at around 3.2% versus VYM's 2.3%. It sounds small, but on $100,000, that's about $900 extra of income per year. And if you reinvest that over a decade, that compounds into real money. And once again, for a fund whose whole job is for income and yield, more income is the game here. Second is that I love the fact that SCHD has a quality company filter. 10 years of required dividend history plus a financial strength ranking filters out a lot of the shaky high yielders that look great on paper right until they cut their dividend outlook. And now the honest knock on SCHD is definitely more of a value play. So when tech and growth lead the market, SCHD kind of sits out on a lot of that performance. And that's why VYM beat it over the past 5 years. And here's the main sticking point for me is when I buy a dividend fund, I'm buying stability and income, and having over 7% of a fund that's in a single cyclical tech company that pays a very small dividend is the opposite of what I want in a dividend ETF. So once again, SCHD pays more, it screens harder, and it still has out-earned VYM over 10 years and its entire lifetime. So if you're looking for a bigger, steadier income and a fund built to play defense, SCHD is the one that I would add. And if you want something that's a little bit cheaper, that hugs the broader market, and the concentration risk of tech doesn't bother you, VYM is a good enough fund for that. And that's my take. Let me know what you guys think in the comments below. Which ETFs you guys prefer, and then what should I cover next? And of course, if this helped, please hit the subscribe button. And if you guys want to track me everywhere else, follow me on all my socials, which is X, Instagram, Substack. And if you want to track my whole portfolio for free, the Blossom Social app, link is in the description below. And if you're ready to start investing, my favorite brokerage accounts are linked in the description below as well. Now, thanks for watching, and I'll see you guys in the next one.